This is the insurance product that now dominates how Americans buy long-term care coverage, and most people have never heard of it. Hybrid long-term care insurance has quietly overtaken traditional policies, solving the biggest complaint people had for decades, which was paying premiums for years and getting nothing back if care was never needed. Today I'm breaking down how hybrid long-term care insurance actually works, who it's built for, and whether the benefits really justify the trade-offs. This product can be extremely effective in the right situation, but it can also end up being the most expensive path if you don't fully understand what you're buying, which is why getting clear on the details matters more than anything else. Why traditional long-term care insurance fell apart. To understand why hybrid policies even exist, you have to look at what happened to the traditional market, and the reality is that it collapsed under its own assumptions. Back around the year 2000, over 100 companies were selling standalone long-term care insurance, and about 755,000 policies were being issued every year, which made it one of the fastest-growing segments in the insurance world at the time. The problem started with projections that never matched reality, because insurers expected about 4 to 5% of policyholders to drop their coverage annually, while in practice, less than 1% ever did, which meant far more people kept their policies than expected. At the same time, claims came in higher and lasted longer than predicted, and a prolonged low-interest rate environment cut into the investment returns insurers were relying on to stay profitable, which created pressure that kept building behind the scenes until it finally showed up in pricing. The result hit policyholders directly. Premium increases spread across the industry, and the average cumulative rate hike reached 112%, while some individuals watched their premiums double or even triple over time. That changed everything. MetLife pulled out in 2010, impacting around 600,000 policyholders, and that exit was followed by Prudential in 2012 and John Hancock in 2016, even though John Hancock alone held about 14% of the market with 1.2 million policies in force. By 2012, more than 75% of standalone carriers had already left, and by 2022, new policy sales had dropped to just 36,872 across the entire country. What nobody expected was how quickly trust would disappear. People saw a product where costs could spike without warning, and where never needing care meant losing every dollar paid in, which forced the industry to rethink the entire model. That's where hybrid policies came in. How hybrid long-term care insurance actually works. A hybrid policy blends long-term care coverage with either permanent life insurance or a fixed annuity, which means you're not buying a single-purpose product anymore, but rather a structure that serves multiple outcomes depending on what happens. The key difference shows up immediately. If care is needed, the policy pays out for long-term care, and if care is never needed, the benefit shifts to a tax-free death payout for your beneficiaries, while surrendering the policy usually returns somewhere between 70 and 100% of what you put in. There are two main structures. One version pairs life insurance with long-term care coverage, where you either deposit a lump sum or spread payments over 5 to 10 years, and that funding creates a death benefit that also serves as the base for your care coverage. A $100,000 premium, for example, might generate a $200,000 death benefit and up to $600,000 in total long-term care benefits, since policies often multiply the base value by 2 to 6 times. Once care begins, the death benefit gets used first, and then an additional extension pool kicks in, while many contracts still preserve a small residual payout, often around $10,000, even after everything else has been used. The second version uses an annuity. You deposit money into a fixed annuity, and if long-term care becomes necessary, that value can be accessed tax-free with a multiplier applied, while unused funds continue behaving like a normal annuity and pass to beneficiaries if never needed. And this is where the structure becomes practical. Benefits trigger when a licensed healthcare professional confirms that at least 2 of 6 daily activities can no longer be performed independently, including bathing, dressing, eating, toileting, transferring, or continence, or when a severe cognitive condition like Alzheimer's or dementia is present. A waiting period usually applies, often between 0 and 90 days, before payments begin. The pros. What makes hybrids attractive? The biggest shift with hybrid policies comes down to certainty. Every outcome leads somewhere. The use it or lose it problem disappears completely, because needing care activates the benefits. Skipping care leaves a death benefit for your family, and exiting the policy returns a large portion of your money, which means value is preserved no matter how things play out. A 60-year-old woman putting in $90,000, for example, could end up with a $4,000 death benefit and $463,000 in care coverage, and that structure guarantees something is received. Another major advantage is stability. Premiums are locked in at the start and cannot increase later, which stands in sharp contrast to traditional policies that saw average increases of 112%, and that predictability alone holds a lot of weight for people who watch those increases happen. Leverage is where things really stand out. A single $100,000 premium can expand into $400,000 in tax-free care benefits, which creates a 4 to 6 times multiplier that's difficult to find in any other conservative financial product. Tax treatment adds another layer. The Pension Protection Act of 2006, which took effect in 2010, made long-term care benefits from qualified hybrid policies tax-free, and it also enabled 1035 exchanges, meaning existing life insurance or annuity contracts can be repositioned into hybrids without triggering taxes on gains. That becomes especially useful if an older annuity has built up taxable gains, because moving it into a hybrid effectively removes that tax burden. Approval rates can also be more forgiving. Traditional long-term care insurance declines about 38% of applicants between ages 65 and 69, and 47% between 70 and 74, while some annuity-based hybrids like Global Atlantic's 4Care approve around 94% of applicants and often skip medical exams entirely. The cons, where hybrids fall short, cost is the first issue that shows up, and it's not a small one. Hybrid policies can run 2 to 4 times more expensive than traditional long-term care insurance for similar coverage, which means a 55-year-old man might pay about $900 annually for traditional coverage, while a comparable hybrid could cost around $3,544 per year, or over $52,000 upfront. That difference adds up quickly. Less efficiency per dollar follows from that. Since part of the premium funds the death benefit and cash value, less goes directly toward long-term care coverage, so anyone focused strictly on maximizing care benefits will get more value from a traditional policy. There's also a structural reality that often gets overlooked. The 3 benefits idea sounds appealing, but in practice only one outcome fully pays out, because a typical 2 to 3 year care claim will drain both the death benefit and the cash value, which led industry veteran Bill Comfort to describe these policies as use it and lose it. Opportunity cost plays a role as well. Locking $50,000 into a single product means that money isn't invested elsewhere, and financial planner Michael Kitces points out that insurers benefit if interest rates rise, while policyholders don't see those gains. Inflation protection can also be limited. Without strong growth features, $100,000 in coverage today might only cover 4 to 6 months of care in 15 to 20 years, which becomes a real issue given how quickly costs have been increasing. 2 final details matter more than most people realize. Hybrid premiums usually don't qualify for tax deductions, while traditional policies often do within IRS limits, and hybrid policies don't qualify for state partnership programs, which exist in about 45 states and allow dollar-for-dollar asset protection for Medicaid eligibility. A traditional policy paying $200,000 could allow someone to keep an additional $200,000 in assets and still qualify, while hybrids offer none of that protection. The numbers that frame the decision. The broader picture makes the decision harder to ignore. According to HHS data, 56% of people turning 65 today will need long-term services at some point, and nearly 1 in 5 will face costs exceeding $200,000 over their lifetime. Those numbers are already high. Current care costs push them even further. A private nursing home room averages about $129,575.75, and here's the disconnect. Only about 3% of Americans over 50 have any form of long-term care insurance, and roughly 7.5 million people in total own a policy, which means most people are exposed to the risk without any structured plan to handle it. One distinction that could save you thousands, one technical detail stands out above everything else, and it comes down to how the policy is classified under tax law. Section 7702B policies follow standardized rules, clear benefit triggers, and established consumer protections, while Section 101G chronic illness riders don't follow the same structure, may require permanent disability, and technically aren't long-term care insurance at all, despite being marketed that way. This matters more than it sounds. In 2018, 101G plans accounted for 64% of all combination policies sold, which means a large portion of buyers may not have been getting true long-term care coverage. That's why one question changes everything. Confirming that a policy qualifies under Section 7702B can determine how benefits trigger, how they're taxed, and how reliable the coverage actually is. So, who is this actually right for? Hybrid long-term care insurance fits best in specific situations, not across the board. Idle assets sitting in savings accounts, CDs, or older life insurance policies often make a strong starting point, because repositioning those funds into a hybrid can create leverage without disrupting other investments. An appreciated annuity can also be a good candidate, especially when a 1035 exchange avoids triggering taxes. Premium stability is another reason people choose hybrids. After seeing traditional policies increase dramatically, locking in fixed cost becomes a priority for many buyers. Health can also influence the decision. If qualifying for traditional coverage is difficult, hybrids may offer a path that wouldn't otherwise exist. Where hybrids don't fit as well becomes just as important. Maximizing long-term care benefits per dollar points back to traditional policies, and limited budgets often require the most efficient use of every premium, which hybrids don't always provide. Anyone relying on partnership program protection for Medicaid planning will also find hybrids lacking in that area. As Christine Benz has pointed out, these products are complex enough that going through the decision with an objective advisor can make a significant difference in understanding the trade-offs. It's a powerful tool, but only when the details are fully understood and the fit is right. If you found this helpful, let me know what other insurance or retirement topics you want broken down next, and I'll see you in the next one.